American Securities Head of U.S. Equity and Quantitative Strategy, Savita Subramanian. She's here in a Fox Business exclusive. Well, yeah, why is it? Listen, 7,100 is your S&P outlook.
Yeah, it's not much further from where we are now.
3% or so. Why aren't you throwing a ticker tape parade with what we just outlined?
Exactly. Everything sounds awesome. Why aren't we more bullish? Well, I mean, here's a little known fact. Years where you have really strong earnings and really good economic growth are typically accompanied by pretty dismal equity returns. So if you go back over history, we've found that the market tends to anticipate these wonderful eras that we're living in right now. And maybe that's why we saw such a strong market rally last year and the year before. I also think that the direction of travel from here is getting less good. It's great right now. Maybe it's like kind of as good as it gets. But think about what's going to happen over the next 12 months. We've got more supply coming online, big IPOs in the wings in these AI companies. That means there's going to be more equity float, which kind of kills one of the bullish stories for the market, which is shrinkage. Remember shrinkage? It was the idea that companies were buying back stock, stock equities were going private. There were just not enough equities to buy, and that was actually bullish. And now we're starting to see more issuance, which is great for, you know, the issuers, but it's not necessarily great for investors. I think on top of that, you've got this air pocket in AI, and
not a bubble. You're calling it an air pocket?
I don't know if it's a bubble. I think where we are now, a lot of these companies that are, spending on CapEx, they don't look as rich as they did back in 2000, but I think that we're not necessarily going to see that monetization and that free cash flow show up this year, maybe even not next year. I mean, power is the bottleneck, and it's going to take a while to get all that stuff in the ground.
With the jobs picture, as we said, let's call it a bit murky.
Yes.
It's not where it was a year ago or 2 years ago. That said, when you look at what is expected, a gain of 70,000, if there is a disappointment, and it comes in a bit lighter than expected, does that change your path for equities?
No, I mean, I think that we're kind of expecting a little bit of a slowdown in demand for hiring. In fact, we've seen kind of a pause in hiring. It's interesting because unemployment has hung in there. It's not necessarily increasing, but hiring was much more vigorous a year ago, even 6 months ago. And now it's again, in this sort of air pocket environment where we're wondering, okay, how much is AI going to really do for these companies? Should we hire that new slate if we're going to get that much more efficient and have to downsize later?
Are you depending at all on any rate cuts this year?
Well, I think we've got 2 cuts penciled in for the second half, but I think that the risk is they might happen slower rather than faster. So, expectations at the beginning of every year are like, we're going to see tons of rate cuts and then those get dialed back a bit. That's another potential negative, because if you think about liquidity, the Fed was cutting last year, profits were accelerating, everything was great. This year, we've got profits accelerating. The Fed is cutting still. They're on a cutting bias, but not as quickly as maybe we thought they would be.
Dallas Fed President Lori Logan said today that if we see further material sort of degradation in the jobs picture, that would basically warrant or justify cutting interest rates.
Yeah, absolutely. And I think if that's the case, then
she's a voter.
Yeah, no, absolutely. And if we do see jobs weaken, I think that's a good reason to cut rates. And in that scenario, you don't necessarily want to be in the highest multiple stocks. You want to be in defensives. You want to be in areas like food and drug stocks, right? I mean, think about what works in a recession. I think that would be the playbook that you'd want to kind of gear towards. And I'm not saying we would be heading into a recession, but it would be a little bit of a slowdown from what everybody's expecting right now.
So there are 11 major S&P sectors. You're overweight 6 of them.
We are.
And I think another 2 or 3 or 4, you are neutral.
Yeah. But we're underweight the biggies. So we're overweight more of the small sectors like financials, materials, energy. Healthcare is a big sector. We're overweight staples. I love staples as a hedge against a slowdown.
Sort of the ones you have to buy versus the things, they sell things you have to buy versus what you want to buy.
Exactly. And when you think about the administration, affordability is the watchword, right? We're hearing a lot about affordability. And what we found is that when that kind of more impacted group of consumers, that lower income cohort, start spending and get a little break, it's typically at lower price point retailers like staples, personal products, not necessarily cars and homes and discretionary items.
I want to push you a little bit more on technology.
Yeah.
Because there have been so many circular trades, and yet we have seen some very bullish moves on behalf of many, many companies in the spending that they have just continued to increase, especially at the hyperscalers.
Yes.
Is that an area where people at Bank of America, they're asking you and you're saying, you know what, maybe go with the side window AI trades, like the energy, creators,
Absolutely.
the nuclear energy.
Power, industrials, other areas, AI adopters like healthcare. I think those could be interesting. I worry about the hyperscalers. I mean, I think these are solid companies. They're not trading at really lofty multiples like what we saw during the bubble. But I do think we're in an environment where their value proposition used to be we're asset light and we buy back a ton of stock. Now they're getting more asset intensive. They're not buying back as much stock, and they're really becoming clunkier. And what we found is that when you're a company that has a high asset base, you're asset intensive, these companies tend to trade at a lower multiple. And we've seen very little multiple compression in a lot of these big tech companies that are becoming more industrial-like. So I think that's something to watch as we kind of progress towards that AI moment.
As the top equity strategist at Bank of America, are you still big, and we talked about this on the show yesterday, buying on the dip? Were you recommending that? That still works?
I think you should buy on some dips, but not all dips. And I think what you should buy is a very different cohort from what has worked for the last 5, 10 years. I mean, think about it. We're in a higher interest rate environment. We're further along in this bull market. We're starting to see some, as you said, murky jobs numbers. Where the employment market isn't necessarily clear. I think that what you want to buy now are companies that are inexpensive, generating cash, and can weather a liquidity downturn rather than just benefit from what we've seen so far.
Speaking of interest rates, the 2-year is at a 4-month low, the 2-year yield.
Yeah.
And I thought that was an interesting move, certainly on a day like today.
Right, right. I mean, and the bond market is telling us something. I think that the idea of where we are now is maybe consumers aren't as strong because the job market is a bit murkier, but you are still seeing this CapEx engine of the hyperscalers drive the economy. So it's a different market environment than what we've seen over the last 20 years, which was super strong consumer and very little manufacturing CapEx. So I think that's where we have to kind of pivot and think about what we want to buy in the next dip.
Yep, Savita, I think that we're hearing that everybody has to be fleet of foot. Definitely. You've got to be ready to pivot.
That's right.
Thank